All right, good morning and good afternoon. So, first and foremost, this is the last video on this current mentorship, and this video will be a raw video using current as we are currently viewing the chat in real time. Right, first and foremost, everything that was discussed in this mentorship from the episode 1 down to episode 27 was for you all as traders to go into the body of price action and practice the information that was shared. Without you practicing it by yourself, there's no way you can understand what goes on in the algorithm and how for you to find your place in this market, because you have to find your place. You cannot copy everybody. So you have to find something that works for you, that that tailors to your own personality. You get to know that by first knowing yourself. The first step to true freedom is knowing yourself, knowing your flaws, knowing all of your positive and negative character traits. That will help you in determining your model. If you are impatient, if you are trust issues, if you have whatever state of being you are, whatever characteristics you have, it will reflect in the marketplace. And another thing is learning how to take a loss. In this industry is filled with ego. There's a lot of ego in this industry, especially traders that trade solely based on their egos. And you see, this is very detrimental to you as traders, to everybody in general. We as traders rely solely on our we rely solely on keeping our emotions in check. This is why the ladies, the female traders, generally do well long term as traders, because they have gone through the roller coasters of different emotions, so they can understand how to take care of their emotions and understand how to facilitate and explain what emotional state they are currently in. Do you understand? But for male traders, we are bombarded by ego, because the ego doesn't want to lose. When we take losses, we go into a tailspin trying to get back our loss back. And this is something that I suffered with personally as a beginning trader. I had an issue with taking losses, because growing up, I hardly take any loss. Everything from school, classes, exams, tests, and everything. This is another problem. Our society has created us to not understand how to take loss. So we look at the world as a class, as a classroom, and the world is not like that. So you have to, by yourself, unlearn some old habits that have been given to you by the society. So you have a lot of unlearning to do. This is what the episode one and episode two of this mentorship is all about. To unlearn, every time you feel lost, go back to episode one and episode two of this 2024 mentorship. You will come back to your bearing. Or conversely, every time you feel lost and you don't want to check this content, you can check from ICT's content, episode 6 of 2022 mentorship and episode 12 of 2022 mentorship. No matter how lost you've been, those episodes will bring you back to your frame of thought to understand, okay, this there's nothing random, there's no chaos exists in this market. So we are operating in that frame of thought that this market is not random, there's no randomness to price. So that way, when you've understood your model and understand how your model prints itself in the marketplace, you know that there is nothing for you to fear missing out, for you to fear taking a loss, because you know your overall trade performance is not based on one trade execution. So you do not want to do this for just once. You want to be able to do this continuously make this a lifestyle. This is a lifestyle. This is not just an industry. This is not just a business. This is a lifestyle. So you have to incorporate this lifestyle to your own individualistic lifestyle. So that way you can align yourself with price in the general terms. Alright. So you need to get over your fear of taking losses because losses is paramount. As traders, you will take a lot of loss. There's a lot of loss coming already in your journey. So you should brace up for it and expect it. Another thing, alright. So another thing is risk management. There are different styles, there are different methods of risk management. So you'd have to learn multiple types of risk management. There is a playlist. If you search risk management ICT concept, there will be a playlist. You will see a playlist by different traders. I might create a playlist also using ICT's video and make a playlist with it. So you can use that for risk management because the risk management video, if I'm to make a video of risk management, it will be hours long because there's a lot of criteria and personal under, personal understanding of risks that goes on in understanding risk management. So there's a lot to go into risk management. So I would advise you to study risk management while you are understanding how price books. I'll give an assignment for Q4. As we proceed inside of Q4, there will be a assignment given to all of you, and the assignment is to be submitted on the 20th of December 2024. The assignment will forge you into a trader that you want to be, into the trader that you need to be. So that is what the assignment will be all about. So if you are not on the Telegram group, do well to click on the link to join because as we go into next year when we'll be doing live trading, actual implementation of this concept, the group will be fully private. So because the idea for the group initially is to create an environment for traders, ICT traders, to have an intimate experience of where you can ask questions to traders that are actually like in the field, they're actually like doing the do and working the work because you cannot learn this idea from just watching videos. All of these videos that you're watching now is not, I'm not saying it's useless, but it's not what you think it is. It's just a video trying to explain some old concept of price action, how price moves and how price books price, how they argue in books price. That is all this video is all about. So you have to so you have to understand that first and foremost, because you understanding that to curtail your expectation to not self destruct because you start thinking it's the fault of the strategy, it's the fault of the language, it's the fault of the system, not acknowledging the fact and taking responsibility for your own inadequacies, for your own flaws, for your own individualistic mistakes that you have your own fingerprint that exists in your doings, in your actions while you engage in price. So the assignment will be given to you for you to do, and I implore all of you to participate in that assignment as it will help you find yourself much better. Let's put it that way. Because you find yourself more in the field. A soldier doesn't exactly learn how to use the gun or how to kill in the during the party session. He only learns how to arrange the gun and disembark the gun. That is all he learns. He learns how to shoot real humans in this field. So you as a soldier, because this is war. If you're thinking this is just video game, even though you can apply game theory while trading, that is just it. Game theory. Don't think that this is the game. We are not playing the game here. This is real life. This is every candlestick you see. This is people's money, this is people's insurance, this is people's livelihood being swept off from the market and other participants taking it out of the market. This is war. So you have to come to this marketplace, you have to come to this industry understanding that you are coming as a warrior, you're coming as an athlete, and you're coming to take your own piece of cake and you move out. That is it. Another thing is understanding when not to do something. Doing the mentorship program, doing the programs, and while we release videos and also in the Telegram group, I've been emphasizing on you understanding the the fingerprints that the algorithm can leave for you so that you can know when not to participate. Because one thing about trading is not about just making money. You can see a pattern that forms multiple times after taking out sell side liquidity, going for buy side liquidity, and all those jargons. You can see that multiple times, and you can take a trade on that note multiple times. But where trader mess up is when they go into a losing streak or when they give back in the market. Because as I said earlier, traders, especially men, they find it hard to take losses. So you'd have to find out within yourself where you're having this conundrum, where you're having these issues about you being unwilling to take losses. You understand? So you have to understand all of this because help you. It will help you and it will be impactful to your development when you understand the idea of taking losses and understand your risk tolerance, understand your own personality because that way you know yourself and that is the best gift that trading can give to you. You knowing yourself, you understanding who you truly are and how you react to taking losses and other issues. All right. So that's it. So this is just me annotating the new week opening gaps and the new day opening gaps to take with this current body of price action. Today is Friday. Um, I'm not taking any trade today. Inside the week, I had one loss for the week. So and that is it. Because the on the higher time frame, the market is giving us a 50 scenario, and I do not like that because we have an order block, a daily bearish order block here, while we also have buy side liquidity here above this place. Let's move this right. So we have buy side liquidity resting here, but from the higher time frames, the market is giving us a choppy 90 in price, even though we'll be chopping higher. So we might come to take out these sell side liquidity lows here and then come to this new day opening gap to take price higher to the new week opening gaps and then above them to buy side liquidity, which is 5,669.8. Right. So back to what we were discussing earlier. So you've gotten the information and understood how price books. Now is for you to practice. Now is for you to use it. I made an analogy in the group that you do not get jacked by watching exercise content. It doesn't work that way. You get jacked by after watching those exercise content, you go by yourself to practice what what is being shown or what was shown there in those videos. All right, because if you do not do that, you are just watching for entertainment purpose. And this is yes, the disclaimer says this is for entertainment purpose, but it's also for educational purpose So education are being in the sense that you should go and learn. You should learn and understand what goes on in this algorithm, how the algorithm actually boosts price. Alright. So you do that by tape reading first. You tape read for a period of time, then you I take it all of you have already been tape reading because I've given multiple assignments on tape reading and you've been told to not take any trade or start trading with a demo account. You are not up for trading demo, especially if you just started with us from episode one. If you are less than a year into the industry, you are a brand new trader, you are a neophyte. So you have to understand this. Alright, so what you should be doing is just tape reading. When the assignment goes live, the assignment will go live on Saturday, this weekend being Saturday on the 13th of sorry on the 14th of September. Today is Friday the 13th. Okay, so back to it. If we are to see price come to this sell side liquidity here, I would expect this low this week, this consecutive equivalent of this week to be violated. Then price will use it as a resistance level and come down for this sell side liquidity rest here because we have this relative equal lows here. We also have this lows resting here. So you see, this is the high we're targeting for the Nasdaq, which is the US 500. So here's this high here coming for this relative equal highs here. So we traded back down inside of this 1 hour fair value gap here. This is a breakaway gap. All of these sets of up close candles, they are breakaway gaps. So we do not expect them to be filled. So price rallies higher, trading above buy side liquidity. So for the current body of price action, we are currently so price has taken out buy side liquidity here and created this swing low here. So let's see if this swing low holds. Here, below here we have sell side liquidity. Like I said earlier, when we have a body of price action giving both indication of a possibility for lower prices and a possibility for higher prices, this is an indication for a low probability trade setup. And you don't want to participate in lower probability setup because those low probability setup they will affect your strike rate. They will give back your wins back to the market, and you do not want that. You want to preserve your capital every time you win. Every time you have a win in the market, you do not want to give it back to the market because that will keep you in a break-even state of being. So you want to limit your losses in the market by being selective with only high probability trade setup. If the trade setup is not of a high probability, you do not want to participate in it. It is not something you are interested in. Alright, so that is it. So after we opened, this is a fake rally here, then price dropped lower, take out sell side liquidity here, then swept higher and fill this imbalance here, trading to this bullish order block here. Then price swept higher again. This is price sweeping buy side liquidity and purging out sell side liquidity. Price purged out this sell side liquidity here. So this is a sell side liquidity purge. Let's from this. So this right here is a sell side liquidity purge. If you are with us, you understand the idea of price sweeping out buy side and purging out sell side because it purges out the opposite pool of liquidity. The pool of liquidity opposite in line with the actual draw on liquidity, actual direction, the actual program that is being executed by the algorithm. So for today's trading, being Friday's trading from the New York midnight open to this current New York session, price has been purging out sell side liquidity and sweeping out buy side. So you see, this is sweeping buy side. Price is still interested in the eyes, so it keeps on sweeping buy side. So we swept buy side multiple times, one, two, three, and also swept buy side again. Yeah. Now we are at this daily bearish order block. This order block here is on the daily. So let's label this daily bearish order block. So we do not lose our bearings. So we had buy side resting here at 10 o'clock. Price left buy side here and dropped lower. Then we close here. Then we'll be having a rally higher like this. So you see, this is not the type of price action you want to participate in because you see there's no price is not rebalancing an imbalance. Price is just chopping higher, chopping higher. So there is little to no narrative to price here on the lower time frame, on this 1 minute time frame. So it is a tricky price action. So and you do not want to base your analysis on the lower time frame. You want your analysis to be from the higher time frame. From the previous video on top-down analysis, we indicated that the lower time frames are subordinate to the higher time frame. So the higher time frames tell the narrative, the bulk of the narrative and the bulk of the story is being told on the higher time frames because these higher time frames, these are where the banks, these are where the institutions participating. Yeah. So the bulk of the volume is on the higher time frames. So you want to participate, you want to base your execution and everything on the higher time frames. You want to base your narrative on the higher time frames while you rely on the lower time frames for the execution. So let's see how price prints. Remember, we have a new week opening gap up here. So seeing if price is interested in lower prices. As smart money traders, one more thing, you do not want to be buying at a premium price, no matter how the the market seems to be at a nice spot for you to engage. You do not want to engage you do not want to be a buyer while price is making highs. You want to, if you are to buy, you would wait for price to drop lower and give you an indication for lower prices. This is only when you can engage in that body of price action. Does that make sense? Because we buy at discount at a discounted price. We buy when the market is cheap and then we sell when it is expensive. So that's it. That is the whole basic of what we do as traders. So you see, as indicated earlier, the order flow here on the lower time frame, price is not filling imbalances. Price is just this is a chop higher. This order block here was expected here, but there's no imbalance here. So validate this as a very high probability order block. So you see, the another block is more of a higher probability when it is coupled with an imbalance with a fair value gap because there's orders when the last buys when the algorithm was pulling in buy orders, buy orders, buy orders. It was when price was dropping lower here. So when price was dropping lower here, there was buy orders being triggered inside of the market by the algorithm. This is not buy as in buying pressure. This is buy orders. The algorithm executing buy orders. So we have that here. So when price rises above this buy orders here, above this opening price of this down close candle, when price rises higher, the algorithm will seek this down close candle where the last buy program was being executed. It will revisit it to continue filling in buy orders by traders like that. So that is it. So this we have this other block become a mitigation block here. So it's being inverted here as a mitigation block. So when an other block is not respected as a bearish order block, it becomes a mitigation block. So that is it. So for that reason, if we are to come to this new week opening gap, we do not want this imbalance to be filled. We would want this to act as a breakaway gap because this is seen as price being extremely bullish because we failed to fill in this fair value gap. This is narrative. So let's see what the US 100 is doing, which is the Nasdaq. So on the Nasdaq, it traded inside of this imbalance here. So I have price balance this imbalance here also. So this is an indication of a high resistance liquidity on signature. So when you have a high resistance liquidity on signature, you don't want to be you don't want to trade those signatures, especially as a developing trader, as a newly developing trader. It's better for you to just save your bullets and come back another day. Save your capital because the number one goal as traders is capital preservation. So I would want to see this as an inverted fair value gap here. So this imbalance here should be an inverted fair value gap taking price to this low here and also this close if we are coming for this midpoint of this week here. So yeah, we have sell side. So I want price to respect this consecutive equipment of this week here and come for this sell side. Okay. You see, there's little to no retracement in this body of price action. Price is just going where it wants to go. And you do not want to be participating in this kind of body of price action. You want to participate in price action that is giving you feedback, that is giving you a direct feedback and not giving you a 50-50 scenario or not retracing to your point of interest, your PDRAs. So you want price to be respecting your PDRAs that has been indicated by the algorithm. So would likely not come to this sell side liquidity, but you do not need price to go to your join liquidity for you to be profitable. When you have outlined if this is a high probability, if this is a low resistance liquidity on signature, you do not want, you do not expect to see price come to your lows, to your join liquidity every single time for you to be profitable. So you need to understand when to be nimble in price. You need to understand when to take your portion off and go. For example, if you're trading from this immediate balance here after price then this break rate gap here, this is a balanced price range because we have price offered buy side delivery and then sell side delivery. So this price range now is balanced. This is the balanced price range. You can still extend this imbalance here because you can still extend this imbalance here because all of these up close candles, the average sees all of this as one individual candle because they are all comprised of an imbalance. So this is the balance price range. So when price make this balance price range and then drop lower, the low of this candle here and the high of this candle or the opening of this candle, you expect price to balance. These are immediate rebalances. Like think of a fair value gap that does not have a gap like this, that does not have a gap like this. Think of it like the algorithm. Remember the paint brush analogy that was illustrated in episode 1 and episode 2. So when price creates something like this, so and we are to go next. If price starts the next candle here like this, so you have an imbalance. There's unfilled price action here. In this case, this is a liquidity void. This is like a liquidity void. But when you have this, when you have this portion of price action like this, and it is like this imbalance like this is a fair value gap. But when you have the next candle trading just at the low of the first previous candle, the algorithm sees this as price balancing this imbalance here. So the algorithm sees imbalances. What the algorithm sees mostly is just imbalances and liquidities. So when there's an imbalance left in price, the algorithm will be eager to rebalance that imbalance. Does that make sense? So that is the whole basic of how price is booked, from imbalances to liquidity pools, from liquidity pools to imbalances. That's all. Let's take this off. I hope you got the illustration. So if we are to go for this close here, this is blue here. If we are to go for this close here, I do not want to see this eye, the eye of this 1029 candle violated. If this eye of the if the eye of this candle is violated, yeah, this means the candle that balanced that imbalance. This is like the intermediate sell high because this is the candle that rebalanced this imbalance. So this is an immediate rebalance. So when an intermediate term high is being violated, this is the algorithm telling you that your narrative is wrong, or you are in a uncharted territory, because price is often price is violating intermediate term highs and also violating intermediate term lows, which is indicative of a choppy price action. This is how you understand a choppy price action model. So if we are to come for this lows here, price should not violate this high here, because this is an intermediate high. So you have this long term high and you have this long term low. You have this intermediate term high, you have this as an intermediate term low, like that. So now this is a short term high. This rally higher, you are seeing this as a short term high. So you do not want price to violate this intermediate term high here. So let's watch how the algorithm boosts price. So you need to take trade. Take trade, especially sessions like this. This will help you to foresee and to predetermine bodies of price action you do not want to engage in. So you have price respecting this imbalance here. This is a BC. So price is reacting from this BC here. So you are currently watching the bodies. In bodies of price action like this, most times the bodies are off. They do not align the way we understand how bodies should align inside of PD arrays. So when you have price actions like this, you see a discrepancies in the precision of price. So when this discrepancies is being noticed by you, you understand that the algorithm is of a lower probability. The stations is of lower probability. So that's it. So we want to see this violated. If this high here is violated, this intermediate high, then we are closed for the session, for the TPD session, because we've already indicated that this is a choppy session, right? So I hope you got something from this video. I'll repeat the rest of the session on my own, and I'll talk to you in the next video. But for this current mentorship playlist, this is the last video. So I employ all of you to go study from the episode 1 down to this episode. And every time you feel lost in yourself, every time you feel lost, you go back to your journal. You want to keep a journal. You see, I cannot overemphasize the importance of you having a journal. A journal is your personal trading book. Everything I'm saying here is my own personal, individual understanding of price, and there's no way I can impute my own individual understanding of price to you. I can only give you an explanation or an excuse on why price is doing what it's doing. I'm only telling you a language. This Friday the 13th of September 2024, there will never be a Friday the 13th September 2024. So the information being given to you here, you cannot use it to make money. So you are not here to make money. You are here to first learn how to read price action. Even though our goals as your main aim here, this is me shooting myself in the foot though. But your main aim here is for you to make money first and foremost. You are not being hypocritical about that. But for you to make money, you must first understand how this algorithm books price and understand when to engage and when to not engage. Because you can make money in the market. That's not the problem. The problem is keeping the money. Can you keep the money? Can you ensure that you sit on your hands and not press a button just for the sake of you try to do something or looking for a dopamine hit? You're looking for something to entice you. You're looking for your attention span is too low. So you want to do something. You want to be engaging. You can't be bored. You do not understand the concept of being bored because you are overstimulated by your environment. Your environment, your phones, your TVs, everything around you overstimulates you. So you cannot sit on your hands. So you need to forge that. You need to forge discipline. This is where the assignment going into Q4 will come into handy. The assignment will be for 3 months. It will be a 3 month assignment and it will be submitted by the 20th of December. So it will be a concise assignment and it will give you everything you need for you to build your own model. But first, you need to get your journal and you need to journal effectively. You need to have different journals, not just one journal. You need to have a journal for your mindset. You need to have a journal for your technicals. For the technicals, the things you see in price action. For example, when an intermediate term high is violated, that is price telling you that you are at the wrong side of the market because this is market structure. Market structure does not just tell you the market structure in line with your own bias, with your own personal bias. Your personal bias can be wrong. So the market structure can give you an idea on when your personal bias is wrong. And the market structure can give you an idea when your personal bias is on side. For example, when an intermediate term high has balanced and imbalance, you do not expect that intermediate term high to be violated. So when that intermediate term high has been respected, you understand that yes, you are in line with the algorithm, you are in line with order flow. That is market structure being in line with order flow. All what you're doing essentially is imputing all of this language together as and making it one. For example, I was illustrating something about basketball to a friend. In basketball, there are many rules. Many people do not like playing basketball because of the rules, because of the complexities of the rules. But basketball is not just about the complexities of the rules. The rules are meant for you to be manipulated. The rules are made by men. Men made the rules. It's man's world. So we made the rules. So we have to the rules that are made by men can be manipulated by men. This is why, for example, for basketball, you cannot travel. That traveling is you moving more than 3 steps or 3 seconds while holding the ball, and you cannot double bounce. That means you catching the ball with your 2 hands twice, but you can mix it. I cannot explain the complexities of that. So this is us reaching the low of this new recoupling gap and possibly the high of the new recoupling gap. So as I was saying, so you have to implement the ideas of all the concepts together as one, and then you find the ones that align with your own personality and you make it yours. You make it your individual model. All right. So I'll talk to you in the next video. We'll be releasing weekly reviews and probably weekly forecasts also. So have a nice day and good luck.